All right, let's get straight to it. The entire global landscape has just been redrawn, and if you haven't taken a hard look at your investment strategy in the last few weeks, you're already playing catch up. This is a mandatory update. We're going to break down the new reality for your portfolio now that a critical ceasefire has collapsed, and frankly, the old rulebook has been thrown out the window.
Okay, let's just rip the Band-Aid off with this quote. It's not here to scare you, it's a diagnosis. The old way of doing things, that classic 60-40 portfolio, 60% stocks for growth, 40% bonds for safety, that was built for a completely different world. A world with predictable inflation and stable geopolitics. Well, that world is gone. We're about to show you exactly why that model is a sitting duck in the face of this new, aggressive, energy-driven inflation. So, how in the world did we get here so fast? Well, the market didn't just stumble. It was shoved off a cliff by a massive geopolitical shockwave. This wasn't some slow burn. It was a rapid-fire series of events in the Middle East that completely changed the game for global energy.
What you're looking at here is a conflict that went from 0 to 60 in a matter of weeks. It all kicked off with coordinated strikes on Iranian infrastructure. Now, Iran's response, it wasn't military for military. It was pure economic warfare. They went for the jugular, declaring the Strait of Hormuz closed. That single move basically forced America's hand, leading to a full-on naval blockade. And just like that, the world's most important energy highway became an active war zone.
And this image, well, it shows you the heart of the crisis. The Strait of Hormuz isn't just some random piece of ocean. It's a choke point. It's only about 21 miles wide at its narrowest point. But think about this. Nearly a third of all the world's oil that travels by sea and a fifth of all its liquefied natural gas has to squeeze through that tiny passage every single day. So when you shut that down, you're not just creating a regional problem. You're clamping a critical artery of the entire global economy.
And what was the immediate result? Panic. Pure and simple panic in the energy markets. Brent crude, which is the big international benchmark for oil, just blasted past $102 a barrel, and it felt like it happened overnight. Now, this isn't some small price bump you get from a cold winter. No, this is a seismic global supply shock. It's actually the biggest single disruption to the oil market we've seen in modern history. And the problem goes way beyond just oil. We're talking about a drop of nearly 10% of the entire world's daily crude consumption, just poof, gone from the market. But the strait is also the main exit for liquefied natural gas from Qatar, which triggered insane price spikes in Europe and Asia. And here's the kicker that most people miss. Fertilizer. A third of the world's supply of urea, a key nitrogen fertilizer, flows right through that choke point. This means an energy war has now become a direct threat to the price of food on your plate.
So this is the really crucial part to understand. How does a conflict thousands of miles away end up costing you more at the grocery store? It's all about the ripple effect. And right now, that ripple is a tidal wave, and it's hitting absolutely everyone's wallet. The latest numbers are out, and they are not pretty. We just saw a 0.9% jump in the consumer price index in a single month. To put that into perspective, that's the biggest monthly leap we've seen in 4 years. This isn't just a temporary blip, folks. This is a permanent compounding tax on your money's ability to buy things. It's a quiet transfer of wealth, and it's happening right now. Let's be crystal clear on what this really means. Inflation is just a fancy word for your money losing its power. It's a silent thief. The $100 bill that's in your wallet today, it's going to buy you less gas, less food, less everything next month, and even less the month after that. And in an environment like this one, that process is happening way, way faster. And here's exactly how that chain reaction works. It all starts at the gas pump, right? That's the direct hit you feel immediately. But then, every single company that ships anything at all, their costs just explode. The truck that delivers food to your supermarket, the cargo plane with electronics, the train carrying materials, it all just got a lot more expensive. And where do those costs go? They get passed right on down the line to you, the consumer. And that's how you get higher prices on pretty much everything you buy. So, naturally, this leads to the big question. Where do you hide? Where do you put your money to keep it safe? See, in a crisis, investors have this instinct to run to what they think are safe havens. But in this specific crisis, in energy-driven inflation shock, the most popular safe haven isn't just a bad idea, it's a trap.
You know the one I'm talking about. Gold. So many people think gold is the ultimate hedge. I mean, it's real, it's been a store of value for thousands of years, and when things get crazy, people pile into it. On the surface, it makes perfect sense, but we have to get past the myth and look at the brutal truth of how gold actually behaves in this kind of situation. And this right here, this is the critical distinction. The myth is that gold protects you from inflation, but the reality is that when inflation is caused by a massive energy shock like this one, central banks really only have one move. They jack up interest rates to slow the economy down and kill demand. And you know what high interest rates are? They are pure poison for an asset like gold that doesn't pay you anything. I mean, why would you hold a non-yielding rock when you can suddenly get a high, risk-free return from government bonds?
And, of course, Warren Buffett said it best. Why own a shiny rock that sits in a vault costing you money to store it when you could own a piece of a business that actually produces something, a business that makes goods, provides services, and most importantly, generates cash? His logic is just so powerful right now. You want to own businesses that can raise their prices and that don't need a ton of new cash to operate. Gold, well, it does neither of those things.
Okay, so that brings us to our first real actionable strategy. If the root of the problem is a massive spike in energy prices, well, the most direct way to hedge that is to own the very assets that are cashing in on that spike. You want to be on the right side of this whole thing.
Now, we're not just talking about buying any old energy stock. The goal here is to find what are called energy-heavy value stocks. These are the producers, the companies literally pulling oil and natural gas out of the ground. Their profits are directly linked to the price of the stuff they sell. That gives them incredible, almost automatic pricing power in an environment like this one. So how do you do this without getting caught up in the mania and buying at the absolute peak? Well, here's a four-step process that the pros use. Instead of valuing an oil company based on today's crazy price of $102 a barrel, you use a much more conservative, long-term average, like, say, the 10-year average of $70. This gives you a normalized picture of what the companies should earn. It stops you from overpaying based on panic and helps you find really solid businesses that might still be cheap even after this initial price jump. But hey, maybe you're looking for a more conservative play. Our second strategy is exactly that. It's for investors who want an ironclad defense, not necessarily aggressive offense. And the best part? It comes with a direct guarantee from the U.S. government. They're called TIPS, Treasury Inflation Protected Securities. These things are a special type of government bond, and they are engineered for one job and one job only: to protect your money's purchasing power from getting eaten alive by inflation. When the CPI, remember that 0.9% number we talked about? When that goes up, the actual value of your TIPS bond automatically goes up right along with it. It's written into the contract. And look, you don't have to take my word for it. This endorsement comes from Benjamin Graham himself, the father of value investing, Warren Buffett's teacher. He saw TIPS as a unique kind of insurance policy. They protect you from two huge risks at the same time: the risk of default, since they're backed by the US government, and the risk of inflation silently stealing your wealth. It's a really powerful defensive tool for a time like this. Okay, let's put it all together. Let's wrap this up into your new actionable playbook for how to handle this incredibly tricky market. This table really spells out the new reality. Your old 60-40 portfolio is in trouble because both stocks and bonds can get hammered when inflation and interest rates are soaring. Gold, this supposed safe haven, actually gets hurt by the very medicine used to fight this crisis. So, the solutions, the new playbook, involve owning things that either benefit from inflation, like those energy value stocks, or assets that are literally built to withstand it, like TIPS. And that really leaves us with the one question you have to ask yourself. The entire nature of financial risk has changed. The strategies that were brilliant for the past decade of low inflation are the exact strategies that are failing today. So you have to look at your portfolio and ask honestly, is it built to fight the last war? Or is it ready for the one we're in right now? Because you have to adapt.